This week we are coming out with two interesting webinars. The first webinar is Saturated Markets, Smarter Allocation, the Multi-Asset Advantage, where we discuss our multi-asset PMS product Sphere. And the second webinar is Simple Behavioral Rules for Smarter Investing, where we discuss about behavioral finance. To join the webinar, click the link below. When we look fixed income outlook for India, especially in the light of the recent geopolitical tensions in the Middle East involving the United States, Israel and Iran, and how this conflict is influencing global oil price and in turn India's bond market. India is the largest importer of crude oil. So any sharp rise in oil price directly affect our economy through a higher import bill, pressure on the rupee and the risk of higher inflation. According to recent market commentary, oil prices have already risen significantly due to the conflict, and if they remain elevated, they could widen India's current account deficit and push inflation expectations higher. For the fixed income market, inflation expectations are extremely important because they influence interest rate policy. If inflation rises due to expensive crude oil, the Reserve Bank of India may have to keep interest rate higher for a longer instead of cutting rates aggressively. Normally, such a situation could push government bond yields higher and bond prices lower. However, what is interesting in the current scenario is that the Indian bond market has remained relatively more stable. Yes, the benchmark 10-year government bond yield has stayed around the mid 6% range despite the geopolitical shock. One of the key reasons for this stability is strong demand from investors and supportive action from the Reserve Bank of India, including liquidity management and bond purchases, which help to stabilize yields and prevent excessive volatility in the market. Another important factor is the India's macroeconomic fundamentals remain relatively strong compared with many global economies, which gives investors confidence in Indian government securities. From a fixed income strategy perspective, investors should remain cautious, focus on quality, use the current opportunity to get out of low quality high yield assets like bottom of the interest rate cycle plus surplus liquidity. Stick to short term maturity investments for short term goals. Invest according to your risk appetite. With market correcting, think about the risk reward trade that works best for you. Also, coming back to the topic, if oil prices remain elevated for a prolonged period, there could be upward pressure on yields in the near term. However, if geopolitical tension ease and crude price stabilize, the bond market could continue to remain supported and may even benefit from eventual monetary easing once inflation risk decline. In this environment, investors may consider focusing on high quality fixed income instruments while keeping an eye on macro developments such as oil prices, inflation data, and RBI policy signals. Overall, the key takeaway for fixed income investors is that while global geopolitics can create short-term volatility, India's bond market continues to be supported by a strong domestic demand and proactive policy management, making fixed income an important and relatively stable component for a diversified investment portfolio going forward. So what do you think this recent instability in the Middle East would have impact in the fixed income market? Share your thoughts in the comment.